Welcome to the Monday edition of On the Tape. I'm Dan Nathan, joined as always by Guy, Christopher, Adami, and EY from SoFi. That would be Liz Young. She works at a place where you can get your money right all in one app. Liz, busy morning for you. SoFi's earnings are out. I know you were just on listening to that call. We're not going to get into that here, but we have a busy earnings week. Some of the largest stocks in the entire market, Apple being one of them, report Thursday after the close. Also Amazon, a bunch of other stuff in there. We have some data. We have ISM manufacturing. We have services. We have weekly claims. We got a bunch of stuff like that. I think earnings are going to be the main event here, people. This is just a little, I don't know, housekeeping or something like that. We have water bottles, risk reversal water bottles. Liz, you're going to want one of these things. And you know how you get one? You go to your favorite podcast store, leave a review for On the Tape, email Amanda at contact@riskreversal.com with a screenshot of that review, and Amanda's going to send you one. How about that?
What do these water bottles look like? I'm kind of snotty about water bottles.
They're pretty dope, Liz, and you will get one if we have you back in the studio.
Those are like the things you put like on your bicycle, and when you're done with them, you throw them to some kid on the side of the road.
These are the ones that you keep. Okay, these are the ones that you keep. All right, guys, let's get into this here. What are you guys most interested in? Usually we start the Monday pod a little bit. We got like dueling calls. We always have Mike Wilson. We have Tom Lee, and we have our main man, Rosie. Mike Wilson's talking this morning a little bit about how 2023 is looking a lot like 2019, this kind of late cycle sort of rally. He reminds us that the 2019 rally, Guy, you know what happened in late 2018. The S&P 500 dropped how much in that last
19.9% from Halloween until Christmas Eve. And then, of course, Jerome Powell, who was newly put into the role probably 5 or 6 months prior, got scared. He got sort of spooked. He also got browbeat by then administration, and he decided to reverse course once again, and then we were off to the races.
Right, and so we were off to the races. We got back a lot of what we lost in Q4 2018, and it's kind of feeling a little bit like that right now. Liz, as a strategist, and you hear this, and Mike is not kind of doing an about face on his bearish sort of call. I think we're all a bit surprised at the shallowness of the earnings recession that we've had, and I guess it's kind of easy to say if you look at the data and you look at the earnings right now, you could say that the stock market last year clearly discounted, you know what I mean, something worse than what has transpired in 2023. How are you thinking about this? And especially maybe seasonally, and I mentioned Tom Lee at Fundstrat, and Tom, who has been very bullish this year, he was also very bullish last year. He's mentioning that August seasonally could be a little difficult of a period here, maybe a little bit of a shallow pullback. How are you thinking about it, like kind of on a macro level here, and how stocks have really done pretty well, in this earnings period here, and they didn't seem to mind whatever the Fed had to say last week? How are you thinking about this the rest of the summer for the stock market?
I think the enthusiasm hasn't faded yet because there hasn't been a reason for it to fade. And we know that earnings have been jumping over that low bar. So there has not been a negative shock. There has also not been a lot of negative economic data. So we sit, we wait, we watch with bated breath every single time a release comes out, particularly the ones that are important like CPI, PCE, jobs numbers. All of that has been either stable or what we expected, and maybe even surprising to the upside. If you look at something like the Citi Economic Surprise Index for the United States, it's been positive for a while. Look at it for China, it's pretty negative. But for the US, it's been positive. So economic data has been surprising to the upside. One of the things I want to say, you mentioned Mike Wilson before. There was some commentary last week, or maybe it was the week before, that he had capitulated. I didn't hear anywhere that he had actually capitulated. I think he pointed out that if things don't go the way that he expects by maybe the end of the third quarter or something closer to the end of the year, then he would have to admit that, you know what, this is not what I thought. But the baseline expectation and the base theory that he has about where we are in the cycle and what's going to happen with earnings has not changed. So it doesn't sound like he's come off of that mark. And I would agree with him. He's much more focused on earnings than I am, but I'm still focused on the macro environment and what I think is happening in the economic cycle, because one of the battle cries that I've had all year is you have to respect the cycle. And I still think we are very late cycle, and that this rally is pretty characteristic of that late cycle behavior. And now everybody is jumping on the bandwagon. I still think that's sort of where we are. And until there's a reason to change course, which I do think will come, we will stay on this wagon.
We had Mike Wilson on our podcast a couple of weeks ago, and he actually talked about in length some of the things that were turned out to be clickbait on the prior week, right? I mean, I think what happened was the market just took, we were wrong in terms of price action and sort of ran with that, thinking that it was some sort of mea culpa and reversal of his opinion or his position. And that's, nothing could be obviously farther from the truth. So, and I think to a certain extent, people have started to figure that out. I don't think Elizabeth ever thought that in the first place, but in a world of, immediacy and just looking at a headline, that's the thesis that people took away from that. With that said, what am I looking at? And EY talks about this, potential re-steepening of the yield curve, and now people are writing about it being a negative sign for liquidity and therefore risk assets, and it's happening. And I think part of the rally on Friday was twofold. I think the data came in a little bit soft, which gave people some sort of hope that, again, the Fed is winning, fine. But the other thing was the Bank of Japan was not as draconian as I think a lot of people thought they would be the night before, and they took some solace from that. But the market is going to absolutely test the BOJ, and I think at some point they're going to flinch, or their markets are just going to start to flinch, and it's going to factor its way into our markets as well. So this re-steepening of the yield curve, which we might be on the precipice of, is something that I'm watching this week for sure.
Yeah, and it goes back to, I think it's interesting when you hear fairly staunch bulls in a raging bull market like Tom has been, suggests that we could see a bit of a pullback. And sometimes I kind of wonder if that comes from just some of the sentiment, some of the pushback that if you're a strategist like Mike or Tom, you're out there talking to a lot of really large PMs, at very big shops, and you kind of incorporate a little bit of the sentiment that they're thinking about. And we also know that, kind of once you get through the kind of the guts of earnings season, which we will be by Friday, and then we're going to get into August, and you have the sorts of gains that we have in the S&P, which is up nearly 20% on the year. The NASDAQ 100's up, 44%. I mean, it's just astounding, right? When you think about that. And I'm looking at my main FactSet screen right here from Friday, and I'll be very frank with you. I was not looking at the markets on Friday. And there was some pretty extraordinary single stock moves. I mean, this is one, and it just catches my eye here because it was like the poster child for the pull forward during the pandemic, or one of, was Roku. You remember this stock at its highs was trading $500. It closed yesterday on Friday afternoon at $90, and that was up from its low. You ready for this, guys? Its low in December was $38. So here it is, from 38 to 89, but down from $500. And when you just think about that, and think about that in market cap terms, this stock just gained, I mean, like a ridiculous amount. It gained $4 billion, got $11.5 billion enterprise value, but it's still down, like 75% from its all-time highs. But then I look around, Guy, and I look at what went on with the semis, right? So Intel is very near a 52-week high. It was left out of this whole AI party, right, for the better part of the last 6 months or so. That's kind of joined the party here. We're looking at, a bunch of these internet names, and I'm aging myself or dating myself a little bit, but they all had huge gains on Friday afternoon, and even Google, extending its gains from its early. What are you thinking about the whole animal spirits? Is that one of those terms that get y'all tweaked a little bit here? Because it feels like we are full on in like crazy, euphoria mode right now.
I think you know the answer to that. There's certain phrases that I will never, ever use. I don't know how much longer I'm going to be on God's green earth, as they say, but I can almost promise you with a great degree of certainty that certain phrases you won't hear from me. And one of those is animal spirits. It's just
heard it. And you know what?
Yeah, there it was.
Just, guys,
who's got that on their bingo
tomorrow
card?
We have what Amanda is calling our bro pod. We have downtown Josh Brown, that is the reform broker of the Compound and Friends. And one of his friends, one of his very good friends, is Michael Batnick, who's his co-host there. But Michael Batnick also has a podcast called Animal Spirits. It's a great podcast. So the two of them are going to be sitting down with us, Guy, in studio. I mean, if you were around, Liz, you could moderate this thing for us, because that would be pretty dope. So,
I'll be in the city tomorrow.
All right, you're coming in then. All right, it's
Watch out.
So check out that. But Guy, let's go back to the euphoria thing here. Are you starting to feel it? Mike used the analog of 2019, and what I think is really interesting about 2019 is that we had a yield curve inversion. We had a Fed that just turned dovish, right? Then we had a re-steepening. This is to kind of Liz's point a little bit, but we also had earnings growth decelerating, and we had margins, decelerating. So, God, I'd love to get your take on that. And then, Liz, just again, like it seems like a good analog from Mike.
Well, that's exactly what we're seeing. I think it is a good analog. Now, part of this also is when basically in August, right? So how many more months left in the year? People that have been on the sidelines are clearly starting to be like, "Oh my God, I need to play catch up here. We need to get involved. This is not working out the way we thought it would work out." And there's obviously the fear of missing out. And I think to a certain extent, there's a lot of that going on. So that late cycle money coming in typically gets in, I think, at the wrong time. And because all the indicators that we talk about continue to sort of go the wrong way. And you mentioned it, earnings deceleration. Liz talked about at the top of the show, these earnings have beaten on a much lowered bar, but at a certain point, the comps get more difficult, right? And then we're going to have a conversation. And I think that's what we're sort of looking at now, because whether you realize it or not, margins have been contracting. Revenue growth has been contracting for a bit. Yes, maybe beating very much lowered expectations, but still contracting. You got to keep these things in context, Dan.
Yeah, one of the things, okay, well, hold on. Let's take 2019 just in a nutshell, right? There was a yield curve inversion, but it was like by a whisker for a half a minute, right? And it was in August, I believe, of that year. That's one of those inversions that in my book doesn't count. That didn't really count as a true signal. Usually, needs to be at least 25 basis points. I would say even 50 basis points, and it needs to last for, let's call it a month. These are just my measurements, just to say that that's a meaningful inversion. It really did happen, right? That didn't occur in 2019. Fast forward a little bit, when the market started going down in October, it was because Jerome Powell said something along the lines of, we are far from neutral. They were trying to find that neutral rate. We are nowhere near a neutral rate right now. The hope of bulls and optimists is that they can do that, go back and find neutral in a gradual way without anything breaking in the meantime. So I understand that that's the suggestion, and that is the hope of people that are really on board in this rally. But this is a completely different environment. We're not even going to try to find neutral this year, let alone maybe the first half of next year, right? And to hope that something won't break between now and then, it's possible. I think all three of us would argue it's less probable because we've got tightening going on and you've got yield curves around the globe. I was trying to find a chart. Don't you hate that when you read an article and you know that it existed and then you can't find it anywhere? So I was looking down this whole time. Anyway, I can't find it, but I read it last night. It was a chart of yield curves re-steepening, not just in the US, in Japan, and around the globe. So now we've got global yield curves re-steepening at a time when the Bank of Japan is messing with the biggest carry trade of all time. So it's a little bit, I think people should be trepidatious about that. And comparing to 2019 or comparing to 1987, right? These are not good comps. You have to remember what happened at the end of 1987, what happened after 2019, right? Let's not tempt fate.
Yeah, and I'm glad you brought that up, because the Bank of Japan, Danny Moses has been talking about this for a while. We've brought it up. We talked about it a few minutes ago as well. But the analog I would use, remember the yuan devalue, I think it was August 2015. If I'm off by a year, I apologize, but I think I'm right. And then you saw the sort of the after effects to the global markets in the wake of that. And don't discount the importance of the Bank of Japan. And again, I think the announcement our Thursday night or their Friday morning wasn't nearly as, I guess, draconian as the market thought it was going to be, but it doesn't mean they're out of the woods at all. They keep moving the goalposts, and at a certain point, they're going to have a problem, and you're starting to see it. Yes, Liz is right. The biggest carry trade in the history of mankind. If these things start to unravel, it has implications for sure to equity markets.
Yeah, and it's interesting. And another thing that a lot of folks got wrong about this year was just kind of when we would start seeing the kind of lag effect of the rate increases, that have gone on now, since March of 2022, and that was the first increase, again since 2018 when that started happening last year. Felix Salmon over at Axios over the weekend had a piece out why the U.S. economy is so immune to rate hikes. We spent 15 years before the rate hikes steadily deleveraging and ensuring that debtors couldn't easily fall victim to a credit crunch. And it's also interesting, and it's not just when you think about debtors, it's consumers, but it's also like businesses, it's also banks, that sort of thing. And so I think that's something that when you think about all that fiscal stimulus that we had in the pandemic, yeah, a lot of that's been wound down, and yeah, we've seen consumer credit go up, but we've also seen like the access to credit now for businesses has been really tough. And he made the point that people are still borrowing, but they're just basically doing it at higher rates. And so that'll be interesting. That might have just pushed out the issues that we might have once the economy eventually slows. But in the meantime, if they still have access to credit and they're still borrowing at higher rates, it is what it is. And he also made the point that household and corporate debt is mostly fixed rate rather than floating rate. So you put those things together and, you say to yourself, right, like sentiment has basically shifted about where we are, I guess, in this economic cycle. And when you put the IRA, you put the CHIPS Act, you put a bunch of the other fiscal stuff in there that's gone on under the Biden administration over the last couple of years, and you're saying to yourself, okay, it makes sense. And at some point in the not so distant future, and Liz, this is something that's going to be hotly debated. The Fed is going to reorient that inflation target a bit higher from that 2% bound. And I think it probably, finds a different equilibrium where the Fed funds is going to go to when things do eventually slow. And I guess, what does that mean for this whole equation too, if you're talking about why we are immune to the rate hikes? Because it really has been this push-pull between deflation pre-pandemic, inflation after now disinflation. You know what I mean? It seems kind of confusing for the normies out there. None of us are economists, but talk to me about what you think that means for risk assets, for stocks in particular.
Yeah, so that's one of those things that I'm going to get the popcorn out for and just wait and watch the Fed try to explain how they're going to raise their target or how they're going to be. I don't even know that we're going to get that state. I don't know that we'll get a statement that says we're going to move it from 2 to 2.5. I think it's going to be more like we're willing to be flexible around the 2% target, or it's going to be we'll make up another new measurement, right? Like the super core minus everything except for toothpaste, that sort of thing. And it'll be like, well, that measurement is exactly where we want it, right? So I think that it actually has the potential for being one of those things that people look at and like, yeah, we expected that to happen. We saw this coming, but then it actually has a much bigger impact than we expect on the market. I don't know what it's going to do in the immediate term, but it could send a message, depending on how he says it, depending on how the message comes out. It could send a message of, we don't have the tools to fix this as much as we thought we did. And they're not as effective as we thought they were, or they're not as effective as they've been for the last 20 to 30 years. And if that's the interpretation, that we don't have the tools, then you could look at that and say, what if we have runaway inflation? What if we have entrenched inflation and we now don't have the tools to fight it? That's sort of the risky part of it. The positive side of it would be, okay, what's the difference between 2 and 2.5? I would actually tell you, if you look over a very long historical period, there's a sweet spot of CPI between 1% and 3% year over year. This is headline CPI, where the market still tends to do pretty well. So I would argue that there is a decent band around that 2% target where we're still okay. It's going to be all about, why did they move it? Why are they being more flexible with it?
That's exact. And listen, they've sort of pigeonholed themselves a bit with this 2%. They've been adamant about it for quite some time. So if they were to just a reverse course seemingly out of nowhere, I don't know what the interpretation of the market would be, but my sense is they'll set the groundwork for exactly that in Jackson Hole. They'll start to put feelers out and see what the reaction is, and you'll know they'll get questions about it. You know, all the nonsense that happens at these things. So that's where they'll start these trial balloons will be floated. But, I think it's important to talk about this, and we've brought it up a number of times. You're seeing, whether people want to acknowledge it or not, sort of a very slow reacceleration, which is going to get a lot faster, of inflation of some of these commodities into the fall and into early part of next year, which I think one of the reasons they've been so steadfast and so hawkish in their tone is because they see that as well. And right before our very eyes, Dan, as you know, crude oil's gotten off the mat, gasoline making 52-week highs. These are important inputs, and the underlying equities have done pretty well. The OIH has gone from 245 almost to 340. I think it made a new 52-week high, which was then a multi-year high last week. So keep an eye on that as well.
Yeah, it's interesting. Guy, you and I have been talking about this a little bit over the last few weeks. I'm kind of skeptical that we see a meaningfully pick up inflation if we don't have a China like reflation of their economy. And I know we've been talking a lot about some of the sort of support that the government is looking to kind of increase consumer behavior and the like. And when you just read about how much household income is wrapped up into the property sector, and we know that the debt issue that they have over there as it relates to real estate, it just seems like one of those things that they're going to be pushing on a string for a while. And then you hear like their youth unemployment rate at like 21%. I don't know. The China thing seems to be coming unwound before our eyes with GDP that looks, like low single digits. You know what I mean? Like that's just something that 5 years ago was kind of like unfathomable. Going back to, guy, when you talked about August of 2015, when the Chinese did devalue the yuan, you remember the mayhem that existed in markets all over the world, in every market, not just the stock market, and currencies and commodities. And so in fixed income, it's just interesting to me. I don't know. I'm just going to push back on that one because I feel like global growth is not really materializing. And so I don't know, man, if all this productivity that has been promised by the trillions of dollars in gains in the stock market related to AI happens, we might see, a less dependence on some of those other like inputs and greater productivity. And so I don't know. That's my take on that. I'm not sure that that's going to be such a headwind.
So, one of the things that we haven't talked about in a while that we used to, and I think people need to revisit now, is you want to watch break even inflation. Watch the 2, the 5, and the 10-year break even inflation levels now. If you're worried about a reacceleration in inflation, because that's the kind of stuff that the Fed is going to look at to try to gauge whether or not it's entrenched, whether or not they've gone far enough, whether or not they need to do more or speed up the asset runoff, all the things that they're going to have to try to figure out if their tool belt is working. I think break even inflation needs to come back into the conversation.
All right, let's hit some earnings really quickly before we get out of here, because again, we said it's a big week. I don't think we kind of need to do Apple or the semis. I think, Guy, you and I talk about all those a whole heck of a lot. But one of the things that I'm actually looking out for is, we just mentioned that obviously Liz's company SoFi reported this morning, trading pretty decently on a beat and raise. I want to see what PayPal, what Square, what Coinbase, some of these fintechs, which were the darlings in 2021, right, and got absolutely nailed. I think they were down, 80 some percent, at their from their highs to their lows last year, and they've all had some big gains. I want to see how investors kind of treat those quarters. I also want to see, this is one, tomorrow before the opening, Uber, okay? This stock has rallied like 50% in the last few months or so alone. It's approaching a $100 billion market cap. Airbnb reports this week, also up 50% in just a matter of months, approaching $100 billion in market cap. DoorDash, which is a $35 billion market cap, also up 80% of the year. So some of these, and I'm bringing these up because these are big market caps for companies that their business models were clearly called into question, or at least the valuations associated relative to their profitability. Now, Airbnb is profitable. Uber is getting more profitable here. DoorDash, obviously, this is a business model where people, the jury's still out on. And I go back to, the fintech names. I mean, PayPal is a very profitable company trading at a very big discount to many of its peers and the market. So at this stage of the game, Guy, I want to see how investors react. And I brought up Roku before. Now, this is a very different name. It's a much smaller market cap, but to see those sorts of moves on beats and raises at this, it's not bullish in my opinion when you're seeing that sort of behavior.
Well, listen, we talked about it with the mega cap names as well. When you're able to add anywhere from 100 to 150 billion dollars of market cap over the course of seemingly minutes, if not a little longer term, that's problematic. That doesn't speak to me, at least, to a market that's functioning properly. It speaks to what you started leading with: is the animal spirits that are alive and well. And we're going to talk again to Batnick tomorrow, and his podcast will be mentioned without question. But it's probably a great time to be bringing that up because that's what's going on right now. But does that speak to a healthy market? In my opinion, absolutely not.
Hey, Liz, what do you make of some of we're seeing investors get a little pickier though on some things, like the reaction to like GM and Ford's earnings, I think are pretty interesting. You know what I mean? And so it seems like a lot of money, that originally flowed into the mega cap tech Then it found its way, like I'm making the point about some of those other tiered sort of names, right? But it's coming out of, some of these stories that had huge runs. Like Ford's a great example, of a stock that was trading at $11.50 in late May and traded as high as $15.50 earlier this month, and now it's at 13. You know what I'm saying? So it feels like it's round tripping on some of that. So investors are getting a bit more picky at a time where the story of the market over the last month and a half was this it widening out, right? This increasing breadth or so. And maybe that's kind of going back to what Tom Lee was saying about August, is that once we get through earnings, right? Once we have a better sense that the Fed is probably pretty close to done in raising interest rates, but keeping them higher for longer, right? Maybe we will see a lot more stock selection from here on out. Maybe the easy money has been made in the stock market so far in 2023.
If that's the case, I think that's the way that it should work. I personally believe that the broadening out of the rally was still momentum based. It was the idea that we had this big run in large cap tech in a very narrow part of the market. And then people got worried, maybe I'm being too bearish. I need to get off the sidelines. I need to put money to work, but I'm not going to put it to work in something that's trading at 80 times forward earnings. So I'm going to put it to work in something else in the market that's cheaper, which is where you found the broadening. Small caps participated, cyclical sectors participated that hadn't before because they looked cheap and all people wanted to do was put money in equities. Now through earnings season, if investors are rational, which over the long term, they become more and more rational. We all know that in the short term, there can be irrational exuberance. That's a book title. I'm not going to coin that phrase, but there can be that in the short term. And if people are rational and paying attention to fundamentals, some of the steam should come out. And that is probably what we're seeing in a decent number of those names. Now, you've got, things like over the last few weeks, meme stocks up. I mean, one of them was up 1,000%, right? When things like that happen, I think naturally investors look at it and say, okay, as much as we've enjoyed that run, probably not sustainable, right? And you get to a point where everything feels a little toppy and people take their foot off their gas a little bit. And I think that's what's happening. Again, that doesn't necessarily mean that it has to all come tumbling down. I think there still would need to be a shock or some kind of headline that sends everybody to the exit door. And that hasn't happened. But some air out of the balloon is natural.
Yeah, and I just want to make one other point. I mean, Guy, you've said, you go out of your way to say, well, I have been, less than bullish, you know what I mean, on the broad market, but like two sectors that have been huge beneficiaries of rotations just of late have been energy. You pointed out the OIH. It's something that you've been bullish on now for a while. Also transports. I mean, look at the way the IYT trades here. So, I mean, this is one thing, and I just want to, we can end on this because I think, Liz, I'm glad you brought up the Mike Wilson thing. We had Mike 2 Fridays ago on our pod, and this was before the Monday headlines were that Mike Wilson throws in the towel. To your point, he did not do that, but he articulated the fact that he was wrong on price. And if he continues to be wrong on some of the other things, then he will actually have to throw in the towel. But the jury's still out. And when you think about this, okay, and it's one of those things that, like, I don't know anybody, okay, on the buy side, who run big money, who really give a shit about what a strategist and what their target is. They care about their thought process. They care about the inputs that go into it. They don't care about year-end targets and this and that or whatever. They care about how do you get to your S&P number? How do you get to the multiple that you think should be on it? What are the commodity price inputs? What are the FX inputs? What are the yield inputs? What are the inflationary input? That's the stuff that really matters. And I got to tell you, as somebody who spent, and Guy, you were on the street for a very long time. When you think about the sorts of people, you don't need them to be right to the penny. You need to actually understand their frameworks and then help that inform your decisions about what you're doing, because at the end of the day, only you can make money in the market, not some strategist who writes a report every Monday or comes on a podcast or goes on CNBC and says this and that or whatever. And I know that that's something, Guy, that you believe in. So maybe we'll end it on that. If you guys have some thoughts about, just listen, I think strategists have a very hard job. Most of them are not economists, right? They're dealing with lots of different inputs.
Let me just Guy, you can respond to this and we can be done with it. I will speak on behalf of myself as a strategist. I'm highly allergic to having a target price, largely because I think my job is to talk about the direction, not necessarily where it's going to end. I am willing to bet that there is not a strategist out there who enjoys having target prices. I think many of them are forced into having targets. And I think we all very well know that if we make a target that's 12 months out, the likelihood of it coming to fruition is slim to none. right? So targets are not all that useful. I think it's about direction, and I think it's about where we are in the cycle and what usually happens.
And I'll end it by saying, and I say this, and this might sound odd, but listen to everybody, but don't listen to anybody. And what that means is you take in all the inputs you possibly can, but your decision is what is going to basically determine whether you make money or lose money. It's not Mike Wilson's fault. It's not Guy Adami's fault, Dan Nathan, Elizabeth Young's fault if you lose money. You're the ultimate decision maker. So take all the inputs you can, listen to everybody, and then make decisions based off how your interpretation of that is. But again, casting blame in this environment, it's never necessarily a good thing.
Yeah. All right. Well, listen, EY from SoFi, that's Liz Young. Thanks for joining us on a Monday morning, Guy, Christopher, Adami. I'll see you a bit later on XMSR Business Radio 132. You and I will be on there every Monday at noon. You guys should call in. You're going to be listening to this by the time we already did it on this Monday, but call in next Monday.